Imagine walking into a bank with almost no money and walking out with $300,000. The bank does not open a vault, count out thousands of bills, and place them in your hands. No armored truck arrives. No pile of cash is transferred from another customer's savings account. Instead, someone approves your mortgage. A few numbers are entered into a computer, your account balance increases, and suddenly you can buy a house. That $300,000 did not exist in your account 5 seconds earlier. Now it does. This sounds like a magic trick, but it is not a secret loophole, a conspiracy, or an accounting error. It is one of the central mechanisms of modern banking. Commercial banks create new deposit money when they issue loans. The loan becomes an asset for the bank, while the new deposit becomes a liability because the bank owes that balance to the customer. Banco de Inglaterra. But there is something important you need to understand. Banks can create money. They cannot create wealth. And the difference between those two things explains almost everything about the financial system. To understand how this works, we have to go back to a time when banks did not look like banks. Centuries ago, merchants and wealthy families stored gold and silver with goldsmiths. Goldsmiths already owned secure buildings, strong boxes, guards, and vaults, so keeping other people's metal safe became a natural business. When someone deposited gold, the goldsmith gave them a receipt. At first, that receipt was simply proof that the gold existed, but carrying a piece of paper was easier than carrying a heavy bag of metal. Over time, people began exchanging the receipts directly. Instead of withdrawing 10 gold coins to buy something, you could hand the seller a receipt representing 10 gold coins. The seller accepted it because the receipt could supposedly be exchanged for real metal later. The paper began behaving like money. Then the goldsmiths noticed something interesting. Most customers did not return for their gold at the same time. Some people deposited metal, others withdrew it. But a large amount usually remained untouched inside the vault. This created an opportunity. The goldsmith could lend some of that metal or issue additional claims against it and charge interest. As long as too many customers did not demand their gold simultaneously, the system continued working. But there was a problem. If everyone became nervous and tried to withdraw at once, the goldsmith might not have enough metal immediately available. The business depended on confidence. Modern banking is far more regulated and technologically advanced, but confidence is still the foundation. Most people imagine a bank working like this. You deposit $1,000. The bank places your $1,000 into a giant pool. Someone else asks for a loan. The bank takes your money from the pool and gives it to that borrower. Banks do use deposits and other funding to support their operations, manage payments, and maintain liquidity. But the idea that each new loan simply transfers a specific pile of pre-existing customer money is incomplete. When a bank approves a new loan, it normally creates a matching deposit. Suppose Sarah wants to borrow $10,000 to start a small business. The bank studies her income, credit history, business plan, collateral, and ability to repay. After deciding that the loan is worth the risk, the bank approves it. At that moment, 2 entries appear on the bank's balance sheet. The bank records a $10,000 loan as an asset because Sarah now owes the bank money. At the same time, the bank credits Sarah's checking account with a $10,000 deposit. That deposit is a liability for the bank because Sarah can spend it, transfer it, or request cash. The bank has created a loan and a deposit at the same time. Sarah has $10,000 in spendable money. She also has $10,000 in debt. The bank has not created a free gift. It has created purchasing power connected to an obligation. That is why saying banks create money out of nothing is both catchy and misleading. The money was created through accounting entries, but it was not created without consequences. It came attached to a contract, interest payments, risk, regulation, and the expectation that the borrower would repay it. Now imagine Sarah uses the $10,000 to buy equipment from a company that banks somewhere else. Sarah sends the payment. Her bank may now need to transfer central bank reserves to the seller's bank to complete settlement between the two institutions. This is where the system becomes more complicated. A bank can create a deposit when it makes a loan, but it must still manage payments leaving the bank. If too many customers transfer money elsewhere, the bank needs sufficient liquidity and access to settlement funds. So banks cannot simply type unlimited numbers into accounts without worrying about what happens next. They must survive the consequences of the money they create, and there are several major limits. The first is borrower demand. A bank cannot make a profitable loan unless someone wants to borrow. During periods of high confidence, households may borrow for homes, cars, education, or businesses. Companies may borrow to expand, hire workers, build factories, or purchase equipment. During a recession, people may become afraid of debt. Businesses may delay investment. Even when banks are willing to lend, fewer qualified customers may want loans. The second limit is credit risk. A loan is valuable to a bank only if the borrower is likely to repay it. A bank that creates too many bad loans is not creating endless wealth. It is filling its balance sheet with promises that may become worthless. When borrowers stop paying, the bank suffers losses. If the losses become large enough, the bank's capital can be wiped out. The third limit is capital regulation. Banks are generally required to fund part of their assets with capital that can absorb losses. The exact requirements depend on the institution, the assets it owns, and the rules governing it. A risky loan usually places more pressure on a bank than a safer asset. This means a bank cannot expand forever without obtaining more capital or changing the composition of its balance sheet. The fourth limit is liquidity. Customers expect bank deposits to be usable immediately, but many bank assets, such as mortgages, are repaid over years. This creates a mismatch. The customer's deposit can leave today. The mortgage may not be fully repaid for 30 years. Banks must therefore maintain liquidity, obtain funding, and ensure that they can complete payments even when money moves to other institutions. The fifth limit is profitability. Banks do not make loans merely because they possess the technical ability to create deposits. They lend when the expected interest and fees are likely to compensate them for funding costs, operating expenses, regulation, and the possibility of default. A loan that appears too risky or unprofitable may be rejected. And then there is the central bank. In the United States, the Federal Reserve influences financial conditions mainly through monetary policy. Changes in interest rates affect borrowing costs, bank funding conditions, asset prices, consumer behavior, and the demand for loans. When rates rise, mortgages, credit cards, and business loans generally become more expensive. Some borrowers decide not to borrow. Banks may also tighten lending standards because the economic environment has become riskier. Credit creation slows. When interest rates fall, borrowing may become more attractive. More households refinance mortgages. More businesses consider expansion. More people finance homes, vehicles, and investments. Credit creation can accelerate. The central bank does not usually decide whether Sarah receives her individual business loan, but it shapes the environment in which thousands of banks and millions of borrowers make those decisions. This is why monetary policy affects money creation without requiring the central bank to print every dollar itself. The Federal Reserve defines the money supply as including physical currency, as well as balances held in transaction and other liquid bank accounts. Much of the money people use every day is therefore not paper cash, it is bank account money. Reserve a Federal too. Now here is where the story becomes even stranger. When banks make loans, deposit money can be created. When borrowers repay the principal, that deposit money can be destroyed. Return to Sarah. She borrowed $10,000. Months later, she pays $500 toward the principal using money from her bank account. Her deposit balance falls by $500. The amount she owes also falls by $500. The bank's loan asset becomes smaller, and its deposit liability becomes smaller. That portion of the deposit money disappears from the banking system. It is not placed in a special box waiting to be lent again. The accounting entries are reduced. The Bank of England describes this process directly. Banks create electronic deposit money through lending, while repayment of loan principal removes that money. Banco de Inglaterra 3. Interest works differently. The interest paid by the borrower becomes revenue for the bank. The bank may use that revenue to pay employees, cover expenses, reward depositors, build capital, or distribute profits. The principal reduces the loan itself. This cycle of creation and destruction happens constantly. New mortgages create deposits. Mortgage repayments reduce them. New business loans create deposits. Repayment reduces them. Banks purchase certain assets from non-banks and may create deposits in the process. Customers move deposits between banks. Governments tax and spend. Central banks buy and sell assets. Millions of transactions continuously reshape the quantity and location of money. This is not a machine producing money in one direction forever. It is a moving system. But why allow private banks to create money at all? Because credit can turn future income into present investment. A family does not have to save the entire price of a house before moving in. A farmer can purchase equipment before the harvest arrives. A business can build a factory before earning revenue from the products that factory will make. A student can finance education before beginning a career. Credit allows people to act today based on what they expect to earn tomorrow. When used carefully, it can support production, employment, housing, innovation, and economic growth. But the same mechanism can become dangerous. Banks make money when they issue profitable loans. Borrowers often become more confident when asset prices rise. If houses keep becoming more expensive, banks may feel safer issuing mortgages because the property securing the loan is gaining value. Buyers may borrow more because they fear being priced out. More lending creates more purchasing power. More purchasing power chases the available houses. Prices rise further. The rising prices then appear to justify even more lending. This can become a feedback loop. Credit pushes asset prices upward. Higher asset prices encourage more credit. For a while, everyone may feel richer. Homeowners see their property values rise. Banks report profits. Construction expands. Investors celebrate. But the wealth may depend on increasingly large amounts of debt. If borrowers begin defaulting or prices stop rising, the cycle can reverse. Banks tighten lending. Fewer buyers can obtain financing. Asset prices weaken. Collateral becomes less valuable. Borrowers and banks suffer losses. Credit creation slows sharply. The same system that expanded spending power can suddenly remove it. This dynamic played a major role in the global financial crisis of 2007-2009. Years of risky mortgage lending, securitization, leverage, and misplaced confidence left the financial system vulnerable when U.S. housing prices declined and mortgage defaults increased. Banks had not simply printed cash and hidden it in vaults. They had created vast networks of loans, deposits, securities, and promises whose values depended on borrowers continuing to pay. Once confidence collapsed, institutions stopped trusting one another. Funding disappeared, credit contracted, businesses struggled to borrow, households reduced spending, unemployment rose. The crisis demonstrated something uncomfortable. Money creation is not merely an accounting curiosity. It can shape the entire economy. It can determine who can buy a home, which businesses survive, how expensive assets become, and how severe a recession feels. It can also affect inequality. Newly created bank money does not appear equally in every person's account. It enters the economy through specific loans and asset purchases. Banks tend to lend to borrowers who appear able to repay. That often means people who already have stable income, strong credit, valuable collateral, or established businesses. A person who owns property may borrow against it to purchase another asset. Someone without assets may face higher rates or rejection. This does not mean every loan makes the rich richer or that banks secretly choose the winners of society. But the structure of credit matters. The ability to borrow cheaply can create opportunities. The inability to borrow, or the need to borrow at extremely high rates, can make building wealth much harder. Now consider the phrase, money in the bank. Most people imagine their deposit sitting safely inside the institution untouched. But your deposit is not a sealed envelope with your name on it. It is a claim against the bank. The bank owes you that balance. The bank's assets include loans, securities, reserves, and other financial claims. Normally, this arrangement works so smoothly that $1 in a bank account feels exactly like a dollar bill. In the United States, deposit insurance, bank supervision, regulation, and access to central bank liquidity help support confidence that commercial bank money can be exchanged at par with physical dollars or transferred to another bank. Reserve a Federal 4. You open an app and see $2,000. You do not usually ask which mortgages, securities, reserves, or capital support that balance. You trust that the number will work. And most of the time, it does. That trust is one of the most valuable products the banking system provides, but it is also why bank failures create fear. If customers begin questioning whether their deposits are safe, they may attempt to withdraw or transfer funds. Digital banking makes this faster than ever. A bank run that once required people to form a line outside a building can now happen through phones in a matter of hours. This brings us back to the original question. Do banks really create money out of nothing? They create new deposit money when they lend. The deposit did not need to exist in the borrower's account beforehand, but the bank simultaneously creates a loan that must be repaid. The new money is backed by the borrower's promise, the bank's balance sheet, its capital, its liquidity, regulation, and the wider monetary system. Banks cannot create unlimited money without facing costs and constraints. They cannot create real houses, food, energy, machines, or human labor by typing numbers into a database. If credit expands much faster than the economy's ability to produce real goods and services, the result may be inflation, dangerous debt, or asset bubbles rather than genuine prosperity. Money can purchase resources. It cannot summon those resources into existence. That is the line between money and wealth. A bank can help create the dollars used to finance a new factory. But engineers, builders, materials, energy, organization, and time must still create the factory itself. A loan can finance a business. It cannot guarantee that the business will succeed. Credit can move purchasing power from the future into the present, but eventually the future arrives, and the debt must be repaid. That is the real power of banks. They do not merely store money. They help decide which promises about the future become spendable money today. Every approved mortgage is a prediction that a household will earn enough income for decades. Every business loan is a prediction that an idea will produce future revenue. Every rejected application is a decision that the promise appears too risky. Banks are not printing wealth. They are placing financial bets on the future. Some of those bets build homes, companies, and careers. Others create bubbles, defaults, and crises. So the next time you see numbers appear in a bank account, remember what they represent. Not pieces of paper waiting in a vault. Not free money created without consequence. They represent a chain of promises. A borrower promises to repay the bank. The bank promises to honor the deposit. Other banks promise to accept payments. The central bank supports the settlement system. The government establishes the legal and regulatory structure. And the public agrees to treat the resulting balances as money. The system works because those promises are trusted. Banks can create money with a few accounting entries. But maintaining trust in that money has taken centuries of laws, institutions, crises, regulations, and painful lessons. Creating the number is easy. Making everyone believe the number is worth $1, that is the real trick. 1. https://www.bankofengland.co.uk/quarterly-bulletin/2014/q1/money-creation-in-c 2%, a zero question mark, UTM_source =ChatGPT.com, money creation in the modern economy, Bank of England. 2. https://www.federalreserve.gov/f AQS/money_12845.h TM?UTM_source =CHATGPT.com. The Fed? What is the money supply? Is it important? 3. https://www.bankofengland.co.uk/explainers/how-is-money-created?UTM_source =chat GPT.com. How is money created? Bank of England. 4. https://www.federalreserve.gov/publications/January-2022-CBDC.htm UTM_source =CHATGPT.com. The Fed, money and payments, the US dollar in the age of digital transformation.